Australians have a long history of investing in our four major banks, CBA, ANZ, Westpac and NAB, primarily through deposits and shares listed on the ASX. While RBA rate hikes mean that bank deposits are still offering higher yields than they have in recent years, that income may still be insufficient to many investors. In this video, we want to discuss the middle ground of cash deposits and equity investment in the big four banks, and the unique investment opportunity currently available for investors. By global standards, Australian households have a very small allocation to fixed income. But with ETFs opening access to this enormous market, investors can now take advantage of the income opportunities on offer. To begin with, let's go through the capital structure that most banks use to finance their operations. Banks typically get their funding through a combination of deposits and wholesale sources, which include bonds sold to institutional investors. Australian regulations also mean that banks need to hold a minimum amount of capital, which helps protect both depositors and other senior creditors in the event of a major economic shock. This loss-absorbing capital is essentially investor capital that is at risk. For example, a struggling bank will stop paying dividends for ordinary shares, also known as common equity, before it stops paying dividends for hybrids. And it will stop paying hybrid dividends before it stops paying coupons on subordinated debt. At the top of the structure are secured bonds and cash deposits, which are considered the safest investments. Each level of the capital structure acts as a line of defense for the levels above it. As we move from the top of the capital structure down, required returns and yields typically increase along with risk. In this video, we'll be focusing on subordinated debt, which sits in the middle of the capital stack. BetaShares recently launched the Australian Major Bank Subordinated Debt ETF, ASX code BSUB. This ETF aims to target higher yielding subordinated debt whilst maintaining a level of capital stability. This is achieved through holding exposure only to floating rate subordinated bonds issued by the four major Australian banks. Traditional fixed rate bonds carry interest rate risk, meaning the price moves in opposite direction to the changes in interest rate environment. This is because when rates rise, an older bond with lower interest rate payments is worth less than a new bond with interest payments reflecting the latest rates. This was evident in 2022 when the RBA's commencement of rate hikes triggered a big increase in bond yields, contributing to large price declines for the stock of existing fixed rate bonds outstanding, with fixed rate bond indices and funds seeing their largest drawdowns in recorded history. In contrast, floating rate bonds significantly mitigate interest rate risk because their interest payments keep pace with benchmark interest rates. As a result, the price volatility on floating rate bonds is substantially lower than fixed rate bonds. But what this means is that in a period of falling interest rates, the interest payment on floating rate subordinated bonds can be expected to fall. Investors searching for a higher yielding alternative to bank deposits yet looking to maintain a level of capital stability might consider floating rate bonds. In addition to the floating rate nature of BSUB, there's also an opportunity that currently exists in the Australian subordinated debt market. Consider bank hybrids. Hybrids held in our Australian Major Bank Hybrids Index ETF, ASX code BHYB, are a loss-absorbing layer of capital that are usually preference shares with features of a call option. While hybrids typically pay a higher fully franked yield than subordinated debt due to their position in the capital stack, today the yield is higher for subordinated bank bonds. This makes BSUB compelling in the current environment, providing an income uplift from traditional bank deposits which generally have lower risk than bank shares and with daily liquidity. To learn more about our Australian Major Bank Subordinated Debt ETF BSUB, click on the link here. We also have a range of different fixed income ETFs across the capital structure, each of which is linked in the description below.